Welcome, everyone. This is the third annual Silver Summit in the United Kingdom, as we all know. How many, by a show of hands, have been here for all three? It's very impressive. Thank you. And those that have been here on the other two conferences, this being the third, know that I'm rather famous for throwing up a DVD presentation, a little mini movie, if you will. The first year that I was here, I showed two. One was from the movie Rollover on a scramble for liquidity to get back to the U.S. dollar, because in theory it was a docudrama. It was far from reality, although it's touching on reality right now, where there was a liquidity squeeze and everybody had to sell everything that they had to get back to the dollar. The folks that raised their hand, I'm sure some of you recall that little docudrama clip that I showed. I also showed last year and the year before another clip of a movie that showed the problem in the derivatives market and how huge the derivatives market is and the problems that it entailed by doing these very exotic derivatives programs. And the problem with derivatives is that, first of all, we got a taste of it with long-term capital management. And that was basically a $1 trillion problem. In fact, there's a movie that I showed in one of my private seminars called The $1 Trillion Bet. And that entire movie focused on long-term capital management. And here were two Nobel laureates for economics that put together a math model that was so wonderful that all the major investment banks on Wall Street had invested in this. And it did well for a few years. But human behavior cannot be predicted by any math model. It never has and it never will be. But human history tends to repeat. And so I'm going to try to keep calm and cool, even though we are witnessing a much bigger debacle in the gold and silver markets than I ever expected. Yet the fundamentals have not changed. In fact, in my view, they've gotten stronger. So with that, I'm going to press on with my presentation. First, we're going to look at the supply considerations. And this is a slide that I bring to every show and almost every talk that I do. But this shows the bullion only. We're only talking silver and gold bullion here. About 2 billion ounces of gold in 1990, about 2 billion ounces of silver in 1990. Today, the end of 2007, a little bit more, because gold is accumulated, as my friend and associate James Turk talks about, or I should say colleague. Silver, we're under 500 million ounces, and this is verified by the two best studies on silver in the world, one from GFMS, sponsored by the Silver Institute, and the second by CPM Group out of New York, New York. I think an easier, more fundamental way to look at that is how many months of demand resides above ground in silver bullion. It's less than 10 months. If you go back to 1990, where I showed that chart, you're looking at roughly 5 years. So what I'm saying in essence is that 1.5 billion ounces of physical silver has come off the market in the last 15 to 17 years. And that silver, for the most part, has gone into industrial applications, although some has moved into investment hands. Now, on the supply side, sticking on the supply side, what we see is that the silver supply has actually increased from the late 90s to present day. And that's, even though it looks like a slight uptrend, and it is based on this scale, if we look in 1998, we had roughly 550 million ounces of new mining of silver from all sources, and today we're about 650. So we've had an increase of about 100 million ounces on an annual basis over these last several years. And that's rather important, because anyone that's looked at my work from the beginning knows that when I started writing on the internet in the early 2000s, I said that the average deficit was about 100 million ounces a year. And now all mining activity has made up for that deficit. Now, it's not a constant, that's an average number, and I do a lot of things by rule of thumb, because I like to convey ideas and principles, because to me those are more important than the exact numbers. Although I am a detailed guy and I do get into the numbers at times, I think from a more overview perspective it's better to stick with the fundamentals rather than go into great detail. This, again, is looking at the supply side. If you look at mining production, it's about 75% of the market, according to GFMS. Those that just read my most recent internet article knows that it's 70% from last year's study. This is a slide from the previous year. Government sales, 5%. I think they're non-existent, but they're very minimal. And scrap recovery is a full 20% of the market. and it is significant, and it will remain so, although less so in the future. Now the demand side for silver. As I pointed out previously, we have had a deficit between the supply and the demand for several years, and they've just now crossed over here, depending on which study. Again, this is from the Silver Institute, around 2006. So what we're saying, in essence, is that 1.5 billion ounces of physical silver is eaten in here. Now the world supply of silver and the world demand on silver is roughly equal. Now, when I give this slide, some people get upset because they say, well, why would I invest in silver? Because now the supply and demand are equal. And that's a fair question. And as I showed before, we probably have 10 months or less worth of demand physically above ground in silver right now. But if you apply that same logic, you'd have to apply it to gold. And if that were true, you have 40 years of gold above ground because it's not used up like silver is. So if you believe silver is an investment and it does have a monetary component, which I do, then I don't buy the argument. If you buy the argument that it's only industrial metal and we're getting a slight increase in supply, then certainly you're free to make up your own mind. Okay, again, on the demand side, we have the industrial applications, over half the market. Photography, about 15%. Jewelry and silverware never really seem to change that much, and I've studied this market for decades. What's interesting on the jewelry side, where gold you actually will see some investment demand decrease as gold prices go higher. What happens in silver, since it's always lower priced than gold, some of the gold buyers will move into silver jewelry. Silverware, I don't think it's that big, but that's what they claim. Coins and medallions, about 5% of the market. So I can't go back. Oh, I can go back. A point I want to make here is twofold. One, if I took this pie chart back a decade, this number would be 35%, and this number would be 25%. The industrial demand is the largest segment and the fastest growing. That's very important because on the industrial side, silver is priced inelastic. Remember what my colleague James Church said about inelastic? If I'm building a Samsung refrigerator that costs $4,000 and I've got silver imprinted in all the shelves and throughout the entire refrigerator, if silver's $100 an ounce or $5 the ounce, it matters little because I'm only using 1/10 of an ounce of silver per unit, and the unit costs $5,000. So the price impact of silver is irrelevant practically to the overall productive cost of the refrigerator. That's price inelastic. Samsung's going to keep buying silver regardless of the price to produce the end product. That same theory holds true in almost all industrial applications. Again, it's the fastest growing. Photography, 25% dropped off significantly. And I'll go into that next. We look at this chart from the Silver Institute. 1999, we used about 275 million ounces of silver in silver halide processing. Today, about 100 million ounces less, about 175 million. Photography demand has dropped off rapidly the last couple of years. I expected it to be linear, which I was wrong. So is the Silver Institute. We both are. But the main thing to keep in mind, and most people get confused on this, but it's rather simple. Photographic demand is basically a zero-sum game. And the reason is that all silver halide processing comes back and is recycled. So if you look at the numbers, in 1999, 275 million ounces of silver used, 275 million ounces recycled. Today, 175 million ounces used, 175 recycled. Now, I just lied to you slightly, but I did it to make the point. The point is that almost all silver halide is recycled. The recycling of silver is greater than the 175 I said a minute ago. So I want to be clear here. It's greater, and the reason it's greater is because not all of your silver recycling is photographic waste, only most of it. Some of it comes back through some electronics recycling. So it is moving up slightly, but overall, the vast majority, the lion's share of silver recycling is due to photographic waste. It's a chart I made for the Morgan Report a few months ago, and I have a real problem with the investment demand side not being reported correctly in either one of the two main studies, either the Silver Institutes or CPM's. And I want to be clear here because when they say that it's 5% of the market in coins and medallions, that's probably accurate. 5% of the investment demand in coins and medallions is probably very close to what the actual truth is. But what they never discuss is what the bullion demand is for investment purposes. If we look at Barclays, we know we're at about 215 million ounces of silver, according to their website, and that's investment demand. That's the ETF. And if we look at the COMEX, we're looking at about 27%. Now, that's two types of demand here. There's two main categories. It's called eligible and registered. The eligible category is long-term investors that own the metal outright and hold the certificates. They know their bar numbers, they know the weights, and they're actually just paying storage fees of about 1.25% on that metal. And that's 50 million ounces. So if I take 215 and add 50 to it, I've got 265 million ounces. That's investment demand.